Welcome back for another deep dive.
Yeah.
Today we're going to be looking at kind of a classic in the finance world.
Oh, yeah.
The Intelligent Investor by Benjamin Graham.
It's a good one.
It's practically the Bible of value investing.
Definitely.
And it's influenced so many people
Yeah.
from Warren Buffett on down.
Yep.
And really what we're going to try to do is get at the core principles of this book
Okay.
that have kept it relevant for decades.
Sounds good.
And hopefully, equip our listeners to approach the markets with more confidence
Awesome.
and that long-term mindset
Yeah.
that Graham really championed.
Yeah. It's pretty amazing how a book written back in 1949
Right.
still holds up today.
Yeah.
But Graham was really onto something
Yeah.
with his approach.
Yeah.
He really wanted to give people the tools to be intelligent investors.
Right.
Not just speculators.
Yeah.
Chasing, the next hot tip.
Yeah. That seems to be like a really big deal for him,
Huge.
that distinction
Yeah.
between investor
Yes.
and speculator.
Yes.
Why is that so fundamental to his whole approach?
Well, he really saw it as like the difference between approaching the market like a detective
Okay.
versus a gambler.
Oh, interesting.
The investor is carefully analyzing businesses, looking for solid returns,
Yeah.
but also making sure that their principal investment is safe.
Okay.
And they're thinking long term,
Right.
Almost like a business owner.
Okay. Yeah.
The speculator, on the other hand, is really more focused on those short-term market swings,
Gotcha.
reacting to rumors and emotions,
Okay.
rather than really doing that deep research.
So if I'm trying to time the market perfectly
Yeah.
to make a quick buck,
Yeah.
that's speculator territory.
Totally.
But if I'm researching, a company's leadership and their financials and, their place in the market and all of that.
That's the intelligent investor move.
Okay.
Yeah.
Got it.
And to really help people understand, how to think like an investor,
Right.
he came up with this brilliant metaphor
Okay.
called Mr. Market.
All right.
So imagine Mr. Market is this guy who shows up at your door every day
Well,
wanting to buy or sell you stocks.
I'm picturing it.
But the catch is he's wildly emotional.
Okay. So some days he's
Oh, yeah.
super excited, offering me crazy high prices for my stocks. And other days he's totally doom and gloom, begging me to sell low.
You got it.
Okay.
That's the picture.
Oh.
So here's the key.
Okay.
You don't have to play his game,
Oh.
right? You don't have to let his moods
Right.
dictate your choices.
Oh, wait.
You need to step back
Yeah.
and look at the real value of the business, not just the price tag he's slapping on it today.
Yeah. It's like getting caught up in that frenzy of an auction.
Exactly.
You could overpay
Yeah.
if you don't really know what something's worth. And that kind of brings us to, I think, another one of his
Yeah.
key ideas,
Yep.
that margin of safety.
The margin of safety.
Yeah.
Yeah. So this is all about building in a buffer
Okay.
against potential losses.
Okay.
So let's say you're looking at a house and it's estimated to be worth $300,000,
Okay.
but you managed to snag it for $250,000.
All right.
That extra $50,000 is your margin of safety.
Gotcha.
So if the market dips,
Yeah.
or you discover there are some, unexpected repairs,
Yeah.
you've got that cushion.
Okay. So it's kind of
Yeah.
applying that to investing. That margin of safety comes from buying a stock
Yes.
below what I think it's really worth.
Exactly.
It's like a built-in discount.
It is. It is.
Is it?
Even the best investors,
Right.
can make mistakes.
Yeah.
Or things happen that nobody predicted.
Right.
This helps protect your investment.
Now, Graham also recognizes that not all investors are the same.
Totally.
We've got different personalities, different goals. He talks about these two main types,
Yep.
defensive and enterprising.
It's like a personality test.
It is like a personality test.
Yeah.
What are the main differences?
Well, the defensive investor is somebody who really prioritizes
Okay.
safety and simplicity.
Okay.
They're not, spending hours poring over financial statements.
Gotcha.
They're more the set it and forget it type, looking for steady growth over time.
Okay.
Graham suggests they focus on a diversified portfolio
Okay.
of stocks and bonds
Yeah.
with minimal tinkering.
That sounds like a good place to start.
Yeah.
Or maybe if you don't have a lot of time
Yeah.
to dedicate to it.
Exactly.
What about the enterprising investor?
All right. So the enterprising investor.
They sound a little more
Oh, yeah.
adventurous?
Yeah.
What are they all about?
They're willing to put in the time
Okay.
to really dig into individual companies hunting for those undervalued gems that the market might be overlooking. They're looking for potentially higher returns, but also taking on more risk.
Yeah, so they need to be comfortable with financial statements and all the
ins and outs,
the market trends and all that good stuff.
You got it.
Okay.
Now, the intelligent investor is packed with all these timeless principles, but the market's obviously evolved since the 1940s. Right. So that's where Jason Zweig's commentary comes in.
Yeah, I've heard great things about his commentary in the updated edition.
Yeah.
What does he bring to the table?
Well, he does a fantastic job of bridging that gap between Graham's era and the modern investor. He connects these core principles to modern concepts like index funds and behavioral finance.
Right.
That whole idea of how our emotions can influence our decisions.
It's nice to know that even with all the, high-tech trading platforms and the instant information we have, that those fundamental principles still hold true.
They do.
Good.
And in a world that often feels so driven by short-term gains and instant gratification, Graham's emphasis on patience and discipline is maybe even more valuable today.
It's almost like a countercultural movement.
It is.
In the world of finance.
Totally.
So we've got some big ideas here from Graham.
Okay.
Knowing the difference between investing and speculating, ignoring Mr. Markets, emotional roller coaster, finding that margin of safety, figuring out which investor type you are.
Okay.
But how do we actually put this into practice?
That's where the rubber meets the road.
Okay.
Up next, we'll dive into some of the specific strategies and techniques that Graham lays out for building a solid, intelligent investment portfolio.
Sounds good. Okay, so we've laid the groundwork with those big picture concepts from Graham. Now let's get into the nitty-gritty.
Okay.
Where do we start if we're going to actually build a portfolio based on these ideas?
Well, one of the key takeaways, I think, from the intelligent investor is that your decisions should be based on thorough analysis, not just following the herd or jumping on the latest trend.
So no more just blindly buying whatever stock is trending on social media.
Exactly. Graham was all about fundamental analysis. He wanted investors to really understand the real value of a business by looking at things like its balance sheet, income statement, cash flow statement.
So we need to be comfortable digging into those financial reports. Understanding what they tell us about a company's profitability, their assets, how much debt they're carrying.
All of that.
It sounds a little intimidating.
It can seem daunting at first. But, Graham actually lays out a pretty clear framework for approaching these reports. He even provides, specific ratios and metrics to look for things like the current ratio, the debt to equity ratio, and of course the price to earnings ratio.
So those ratios can help us kind of gauge a company's financial health.
Exactly.
And their potential for growth.
Yes, exactly.
But I'm guessing there's a lot of nuance.
Oh, yeah.
To interpreting those correctly.
Absolutely. You're right. It's not just about plugging numbers into a formula.
Right.
You have to consider the context of the industry, the company's competitive landscape, all sorts of other factors. But, Graham encourages investors to take a conservative approach. Especially when it comes to things like, earnings projections. Remember that margin of safety. We want to see a track record of consistent profitability, not just, promises of future riches.
So it's more about looking for a company with a solid foundation.
Yes.
Like a house built on bedrock.
That's a great way to put it.
Rather than one that might be, teetering on shaky ground.
Exactly. And speaking of solid foundations, Graham also stressed the importance of a company's management team. Are they ethical? Are they competent? Do they have a clear long-term vision?
It's that human element that can make or break a business.
Totally.
Even if the numbers look good on paper.
Absolutely. And here's another interesting point. Graham actually advised against getting too caught up in trying to time the market perfectly. He believed that it's incredibly difficult, if not impossible, to consistently predict those short-term
Yeah.
Ups and downs.
So instead of stressing about buying at the absolute lowest point and selling at the peak,
exactly,
it's more about finding those undervalued companies.
Yes.
And then holding on to them for the long haul.
The long game.
Letting compounding work its magic.
Exactly. It goes back to that core difference between investing and speculating.
Yeah.
The intelligent investor is playing the long game, not trying to, outsmart the market on a daily basis.
Gotcha.
And speaking of managing risk, Graham was a big advocate for diversification.
Diversification.
Yes.
That's one of those terms you hear thrown around a lot.
It is.
In the investing world.
Yeah.
What does it really mean in practical terms?
Well, it's basically about not putting all your eggs in one basket.
Okay.
You want to spread your investments across different asset classes, industries, and even geographical regions.
Okay.
So that if one investment takes a hit, it doesn't wipe out your entire portfolio.
It's like creating a safety net.
Exactly.
For your investments.
Yeah.
So if you know the tech sector is going through a rough patch, but the healthcare industry is booming, you're less likely to experience a major loss.
Precisely. And Graham offered some specific guidance on how to approach diversification. He suggested holding a mix of stocks and bonds and owning shares in a range of companies across different sectors.
But I've also heard that you can over-diversify.
You can.
Is there a point where having too many different investments actually works against you?
That's a great question. And you're right. There is such a thing as too much diversification. If you own, a tiny sliver of hundreds of different companies, it becomes really difficult to understand each business and manage your portfolio effectively.
It's like trying to juggle too many balls at once.
Exactly.
Eventually, something's got to drop. So it's about finding that sweet spot where you're spreading your risk, but you're still maintaining a portfolio that you can realistically keep track of.
Precisely. And this leads us to another intriguing aspect of Graham's philosophy. The idea of being a contrarian investor.
Contrarian investing, this one always sounds a little rebellious.
It does.
What does it actually entail?
Well, it's about not blindly following the crowd. A contrarian investor is willing to think independently and go against the prevailing sentiment if their analysis suggests that the market is misjudging a company or a situation.
So if everyone is selling off a particular stock in a panic, the contrarian investor might see that as a buying opportunity.
Exactly.
If they believe that the company's fundamentals are still sound.
Well, that's the idea. It takes courage to buy when others are fearful and potentially to sell when everyone else is overly optimistic.
It sounds like it requires a lot of confidence in your own judgment.
It does.
And maybe a strong stomach to handle those market swings.
It's not for everyone, that's for sure. But it's important to note that being a contrarian doesn't mean being reckless. You still need to do your due diligence. Make sure your decisions are grounded in solid research and not just, a hunch or a gut feeling.
So it's about being a skeptical thinker. Not just blindly opposing whatever the popular opinion is.
Exactly.
You need to have a good reason.
You do.
Go against the grain.
You do. And Graham also emphasized that successful contrarian investing often requires a long-term outlook. It might take time for the market to catch up to your assessment of a company's true value.
So patience is key.
It is.
Especially for the contrarian investor. Now, I've always been fascinated by the psychological aspects of investing. It seems like our emotions can really get in the way of making smart decisions.
For sure. You're absolutely right. And Graham recognized this decades ago. He dedicated a whole chapter in The Intelligent Investor to the topic of investor psychology. Exploring how emotions like fear and greed can lead us astray.
It's that classic cycle, isn't it?
It is.
When the market's soaring, everyone gets caught up in the excitement. And they start buying at inflated prices, thinking it'll last forever. And then when the inevitable correction happens, panic sets in. And they sell at a loss, locking in those losses.
That's the pattern. Graham observed time and again. And he believed that the key to breaking free from this emotional roller coaster is to cultivate discipline.
So it's about having the mental fortitude to stick to your investment plan. Even when the market is behaving irrationally or when everyone around you seems to be losing their heads.
It's tough, but it's important.
Yeah.
And it's also about being aware of your own biases and tendencies.
Okay.
We all have them.
Right.
And, understanding how they can influence our investment decisions is a big step towards becoming more rational and level-headed investors.
So it's like having a built-in warning system.
It is.
That helps you avoid those emotional pitfalls.
Exactly. Now, in addition to our own psychological biases, Graham also warned about potential market manipulations and outright scams.
Right.
He was very wary of hype and promotional tactics designed to lure in unsuspecting investors with promises of quick riches or guaranteed returns.
If it sounds too good to be true.
Exactly.
It probably is.
That's the saying.
Yeah.
Graham believed that an intelligent investor should approach the market with a healthy dose of skepticism and always do their own independent research before making any decisions.
So it's about being informed, being discerning.
Yes.
Not being afraid to ask tough questions.
Absolutely. Now, we've covered a lot of ground here.
We have.
From fundamental analysis and diversification to the importance of emotional discipline and skepticism.
But there's one more key element of Graham's philosophy that I think is worth highlighting.
And what's that?
It's the idea that investing should be viewed as a partnership with a business.
Interesting.
When you buy a stock, you're not just buying a piece of paper. You're becoming a part owner of that company.
That's a powerful perspective shift.
It is.
It encourages investors to think more like business owners. With a vested interest in the company's long-term success.
So it's about aligning your interests with those of the company and its management, working together to create value over time.
Precisely. And this brings us back to that core principle of value investing, seeking out companies that are intrinsically undervalued by the market. And holding on to them for the long haul. It's a philosophy that has stood the test of time and continues to guide some of the most successful investors in the world today.
And even though Graham was writing in a different era, his insights remain incredibly relevant.
They do.
For anyone who wants to approach the market with intelligence, discipline, and that long-term perspective.
Long-term perspective.
That he championed.
Absolutely. The Intelligent Investor is a true classic for a reason. It provides a solid foundation for anyone who wants to build wealth steadily and responsibly. And it offers timeless wisdom that can help us navigate the complexities of the market, no matter what challenges lie ahead.
We've covered a lot of ground in this deep dive, exploring those core principles of value investing through the lens of the Intelligent Investor. But before we wrap up, I want to leave you with a provocative thought to ponder. As we've discussed, in today's world, we are bombarded with information.
We are.
Instant analysis and those tempting get-rich-quick schemes. It's easy to feel overwhelmed or tempted to chase the latest trends.
It really is. And it's fascinating how Graham anticipated these challenges decades ago. His emphasis on independent thinking, thorough research, tuning out the noise. It's perhaps even more relevant today than it was back then.
So here's the question I'm pondering now. How can we apply these principles from the Intelligent Investor? Not just to our finances, but to our lives in general.
Interesting.
Can we cultivate that same sense of patience, discipline, rational decision-making?
It's a really intriguing question because, when you think about it, Graham's book isn't just about picking stocks. It's about making smart choices. Period. So whether you're evaluating a potential investment or deciding how to spend your time and energy, those principles can apply.
It makes you wonder, are we as thoughtful and disciplined in other areas of our lives as we are with our investments?
Interesting.
Do we get caught up in the hype? Make impulsive decisions? Or do we step back, do our research, and make choices that align with our long-term goals?
It's easy to get swept up in the moment.
It is.
Especially in a world that's constantly, demanding our attention, pushing us towards instant gratification.
Yeah.
But, Graham's approach really reminds us to slow down, think critically, and focus on what truly matters over the long haul.
And maybe that's the ultimate takeaway from The Intelligent Investor. It's not just a guide to building wealth, but maybe even a roadmap to a more mindful and intentional way of life.
Well said. It encourages us to be more discerning about the information we consume, to resist the urge to follow the crowd blindly and to make decisions based on, our own values and goals.
That's a powerful message.
It is.
Well, as we wrap up our deep dive into The Intelligent Investor, I hope you're walking away not just with some valuable investment insights, but also with a renewed appreciation for the power of, clear thinking, patience, and that long-term perspective that Graham really championed.
And remember, the journey to becoming an intelligent investor or an intelligent human being, for that matter, is ongoing. It's about continually learning, adapting, refining our approach as we navigate, the complexities of life and the market.
Absolutely. It's a lifelong pursuit.
It is.
And who knows? Maybe one day you'll be the one sharing your wisdom and insights with the next generation of investors. Until then, keep those minds curious.
Yes.
And happy investing.